Thank you for checking out Fieldman, Rolapp Associates Municipal Market Update. We post the MMU on a monthly basis to try to give our clients and other municipal market participants a general overview on what's going on in the market. And we try to present it in a relatable way for folks that are not in the market on a daily basis. But this is our 49th posting. And once again, we are posting this the week of June 19th, 2023. My name is Adam Bauer, and I serve as CEO and president of Fieldman, Rolapp Associates. Our first page, put a lot on one chart here, kind of walk through it again. Though I think the most important is on that key is those green bars. You see Fed rate increases. You can see they started in March of 22, and they've continued all the way through March of 23. So quite a few rate increases. You can see what the 10-year Treasury did along the way, and I've explained that kind of November effect a few times. But hopefully what you're also noticing is that yellow line. That's the accumulation of the Fed rate increases, and that key is on the far left, vertical axis. Now, one thing I really want to point out to you, because it's the first time I've been able to say this in some time, is in June, there's no green bar. Now, you might look at that chart and say a few other months, there's no green bars either. But there's always been a green bar going back to March of 22, since that date when there's been a Fed meeting. But we did have a Fed meeting in June of 23, and we did not get an increase. Now, if you're watching the financial news programs, some are calling it pause, some are calling it stop, any number of things to call out. But what you can say for sure is that the Fed did not increase rates in June of 2023. And so we'll see what happens going forward. I believe there is a July meeting coming up, and we'll see what happens then. But this is just a snapshot. We've talked about those rate increases, and you can see how large those 75 basis point increases were June of 22 through November of 22. November of 22 is when the Fed chair said, we might not need to increase as much as we have been, and that's when you saw the 10-year Treasury come down a bit. On our next chart, I referenced a few times with you about the first week in January of 22, when we went from calling inflation transitory to we started just calling it plain old inflation. And at that point in time, rates really started trending upward, even though the Fed didn't start increasing rates to March. And so I've constantly had us kind of reference back to that point. But that yellow greenish line, that is as of 6/16/2023, inverted yield curve for the first portion of that. And then you can compare that to where we were in that blue line from January of 2022. And just to try to put some of this in perspective, if you were an investor and you wanted to invest for 1 year and you wanted to invest in US Treasuries, you were earning something close to 0.5 percentage point in January of 22. Now you're north of 5% for that same maturity. And so you can see quite the change that we've had. And so when you saw investors investing in dividend stocks or investors investing in other things that have yield to them, you can really see why, because if they stuck with treasuries, it was not zero, but what some called near zero. And now they can move money away from those other assets, have them invest in things like treasuries or municipals, and actually achieve some yield with that. Now, on this next page, what we've shown is a 30-year MMD and how it's changed over time. Just want to take a moment to talk about the MMD, the municipal market data. And then we're looking at the AAA. So it attempts to look at a perfect credit in the municipal market and what it would yield on a 30-year basis. As I showed you that last graph, the 30-year has not gone up as much as some of the shorter maturities. So we might not be catching a full effect of rate increases with this chart, but it is something we've referenced for a period of time and we've tracked and have found it to be a useful mechanism to give you all some perspective on where things are. But at the end of May, the 30-year MMD was at 3.5. That was up 11 basis points or 20 basis points over the last 60 days, 11 basis points over the last 30 days. And that kind of gave back almost all the benefit we got in March of those declines. But if you go back to that period of time where I've talked about or not even talked about, but June of 2022, when some of those 75 basis point increases really started, you can see that it was at 2.78 and now we're at 3.5. And then on our next chart, what we're showing here is the AAA MMD in each one of its maturities, years 1 through 30. And those bar charts show the range of interest rates going back to 2005. What the blue line represents is the MMD actual data point for each one of those maturities as of 6/16/2023. So hopefully what you're noticing is on the first 5 years or so, we have elevated interest rates. Year 6 to 30, we're somewhere around average. Good news for most of our issuers is oftentimes you have more principal in the back end than you do the front end. And so even though rates are elevated on the short end of the yield curve, it's not having as big of an impact as it's elevated all the way through. And so this helps when we say rates are high, when we talk about how they've changed since a few years ago. I think this chart really helps it puts it in perspective, is we really are about average with the exception of some of those early maturities, which generally don't have as much principal when you're selling new bonds. Now this chart is gives you a lot of different data points. That top left there gives you some perspective on where we are with volume, and volume's lower than the last few years. To the top right there, you can see the different types of issuance, negotiated, competitive, and direct placements with some of the regional banks who participated frequently in direct placements. Down, you'll likely see that light yellow color be even less than it has been the last year or so. Bottom left there, tax exempt versus taxable. You can see a lot of the debt being done is tax exempt. So that idea of refinancing from tax exempt to taxable because the treasuries are so low, that is not happening very frequently right now. And then to the far right, just give a summary of the refunding versus new money for those transactions that are within the market. You can see we have a little bit more refundings than we have recently or last year. 79% last year versus 75% this year on new money. So the balance of that was absorbed by refinancings. On this chart, we show inflows and outflows into municipal bond funds, and good news, that far right there, you can see that little blip of green, and that shows inflows into the municipal bond funds. Now, volume remains low. And so hopefully that's what you're walking away with this chart. I could get into the week by week comparisons, but really with the exception of that June 5th week, we've had lighter volume than other years in recent memory. So on this next chart, we're showing some of the data points and a national holiday that are this week. And hopefully everyone takes time on Monday to get rest and reflect, and then you can see the data points that we have after that. On our last page here, we show you and provide the contact information for our registered municipal advisors. Encourage you to reach out to any one of them for information. We have our 50th MMU recording next month. If you have any suggestions for us, please send them our way. Sometimes we get suggestions to kind of go over some of the acronyms we use. I try to do that as frequently as possible, but every now and then we do a refresh. If there's something that you are interested in seeing or you are interested in having us cover, please send it our way, and I'll make sure that we give it consideration. Thank you again for your time.